What's up, guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So the Fed fund rate increased again by another 75 basis points. So what does that actually mean? What is actually going to happen? Well, first of all, mortgages have taken a really big increase in it, but let's get on with the mortgage rate update as of 9/21/2022. 30-year fix will be sitting at 5.76%, 15-year fix will be sitting at 4.74%, 30-year high balance will be sitting at 5.84%, DSCR, which is a debt service covered ratio loan. This is a loan product for you to go ahead and qualify the total income coming in from rental, opposed to the total debt that's going out, which is your principal, interest, tax, insurance, and other running costs would be sitting at 8.50%. Bank statement loan will be sitting at 8.12%. This is another one of those non-qualified, non-agency loans. This is where we only approve you based off of the amount of income versus the debits that are happening into your bank statements. That's sitting at 8.12%. FHA 30-year fix will be sitting at 4.98%. 7/6 adjustable rate mortgage will be sitting at 5.83%. USDA 30-year fix will be sitting at 5.03%. VA 30-year fix will be sitting at 4.98%, and hard money fix and flip is going to be sitting at 9.75%. That is going to be your total mortgage rate updates. I don't even know why I do it, because these rates are just going so nuts. They're losing their damn mind. So the Fed fund rate just increased again by another 75 basis points. So who's going to get hit the most? Well, number one, the first thing, as all of us are going to know, is the Fed fund rate is going to go ahead and increase the total amount that you're going to go ahead and pay for groceries at the grocery store. That is going to hit you in the short term, right? Everybody goes to the grocery store. You've all seen it. I actually went there and bought a gallon of milk right now from Vons. Now, my kids, they have organic milk, but still, organic milk was $12 for 1 gallon of milk at my local Vons here in LA. That is just, I don't ever remember paying that much. Now, my wife does most of the grocery shopping, so maybe I'm just stupid. Is that really how much it costs? Let me know in the description below. And before I go on any further, here's my shameless plug for up to 50% commission rebate, 0% listing on selling your current home or any mortgage assistance. A link in the description below. But now that I got that shameless plug out of the way, the second thing that's going to go ahead and get hit is going to be credit cards. Now, since most credit cards have a variable rate, their direct connection to the Fed benchmark is going to be, directly according, because credit is where the Fed fund rate rises. Now, if you don't know what a Fed fund rate is, it is the amount of money that a bank, typically a centralized bank, go ahead and charges another bank to go ahead and buy and sell money. That's all that it is. Now, the annual percentage rates are currently sitting at 18% on an average on credit card. Now, that is just a lot. Number two, of course, number three, we got the food, we have more the credit cards, mortgages. Now, mortgages, the thing that we're actually keeping a close eye on is going to be, number one is going to be the adjustable rate mortgages that are coming to term. Those are going to take such a huge hit because you're either going to go and refinance into another adjustable rate mortgage. What that'll do is that'll keep your payments low, because then it'll just be interest only for the short-term amount of time, whether it's a 5/1 or a 7/1, 7/6, whatever the adjustable rate mortgage is. That is what's going to get affected. Number two is going to be the home equity line of credit. That's something else that we're looking really close into, and that's what everybody, because back in the day, the 2008 crash, it got hit because of these subprime mortgages. Now, the subprime mortgages are just that. It's subprime shit, right? That's all that it is. Subprime means shit. We still have all these subprime mortgages still that we're able to go ahead and buy and sell, but those are going to go ahead and come into effect, and when they come to their maturity date, where they're going to go ahead and get adjusted to principal and interest, and then you're going to have to go ahead and pay more, that is something that we're keeping a close eye on, because if the Fed fund rate is too high and interest rates are too high, you're going to have to go into a mortgaging product that does not qualify under the Fannie Mae and Freddie Mac bucket, and we're going to go ahead and get you into something else that is going to be even at a higher interest rate than we currently are. Now, there are some banks out there that are already over the 7% threshold. We have not gotten there yet, but I mean, like I said in previous videos before, we're going to get above that 7% mark. We're going to be really damn lucky if we don't get into somewhere in the high sevens. Now, high sevens, just to put you in retrospect, now, my mortgage payment before, when I purchased my house, was $4,300 a month. If I bought my same house today, I would be paying about $11,500 for my mortgage. damn, that's crazy. That is absolutely insane. Now the other thing that's going to go ahead and take into effect is going to be auto loans. Auto loans, cars are going to start depreciating, homes are going to start depreciating, because whenever you increase the amount of money that you are charging people, that the income is not coincided with what's going on with the market currently. The amount that cars have appreciated, the amount that homes have appreciated, do not correlate one with how much money people are bringing in as far as income. So whenever you're buying a car, guess what? Your payment is going to go up, but that doesn't mean that your total liabilities with everything else is going to decrease. That doesn't mean that your pay has increased that much to where you're going to go ahead and be able to afford that same payment. So if you're buying, even if you bought something simple, like let's say hypothetically like a Honda, right? Honda is a reliable car. You're going to go ahead and get that. That Honda is still at the interest rates that we're getting hit because you're buying and selling credit. That's what the Fed fund rate does, buying and selling credit. So if the Feds are charging the bank X amount of dollars to go ahead and purchase it, they still have their cost that is associated with selling that credit. And then there you go. You're going to go ahead and instead of paying that $300-$400 car payment, whatever it is, hypothetically speaking, you're paying $600-$700. That is going to hit us in a really, really big way. And then the last part is going to be student loans. Student loans are going to take a really, really big hit. And I feel for anybody who's in the position where they're not, because the Pell Grant right now, they just announced that they're going to go ahead and write off $20,000. $20,000. As long as you file your taxes, that gets written off. You don't have to worry about that. But now it went from 2.75 just last year in 2021 to now 5%. So that means if you are going to go ahead and become a physician, or if you're going to be, you're going to have an Esquire at the end of your name, that is for somebody who wants to go into law, you're going to be paying 5%. Now, all of us, like myself included, we did not have fortunate enough to be part of families that are able to go ahead and help you get through college. We had to go ahead and take out loans. We had to get grants. We have to get whatever we could. Majority of us had to go ahead and pull out loans. Now at 5%, especially when you're going to those higher degrees, when you're going to your master's or your doctorates, that's going to be so crazy. This is going to be what's called the long-term effect, right? So the long-term effect is after you go ahead and purchase your, you'll get whatever student loans you want to get from whoever you get it from. Maybe it's your local credit union. Maybe it's from a Pell Grant or something like that. Or maybe you go and fill out your FAFSA, and then the FAFSA is going to go ahead and give you a pre-populated amount of different lenders that are going to give you, student loans. What happens after you go ahead and graduate school and you're hit at that 5-6%, whatever it's going to be? Well, that's going to be your mortgage rate update for up to 50% commission rebate, 0% listing on selling your current home, and any of the mortgage products that I went ahead and listed. Link in the description below. But listen, I know this is my job, and I'm doing this just to go ahead and do content and then build my brand as much as I possibly can. But we're sitting right now in 9/21/2022. Don't buy a house right now. It doesn't make sense. This is like one of those situations where it's like 2 + 2 = orange, right? It doesn't make any sense. In my mind right now, interest rates are increasing. Home prices have hit a roof. This is the most expensive real estate's ever been in the history of real estate. Why are you going to go ahead and buy a house? That doesn't make any sense. Well, till next video, guys, I really appreciate you watching. Peace.
I don't wanna waste a minute.